Best things in life are free, but you can give them to the birds and bees. I need fun. That's what I want.
Hi everybody, did you like that little bit of lip syncing there? Okay, so today we're going to be talking about how to pay yourself out of your business, okay? So here's Scampy again. As you can see, we've paid him, he's got his salary there and his dividends. Okay, so over to Mahmood is going to go through some really important points, guys.
Thank you very much, Serena. Thank you very much, Scampy. Now, a common question that we always get asked by business owners is, how do we pay ourselves? Now, the most rehearsed routes we know, is you pay yourself a salary when it comes up on the board. Typically, just to rehearse that, typically it's set at a relatively low level, so you can get some credit for your state pension when you eventually retire. The rest is taken out as dividends. Got a difference here, you've got a dividend-free allowance here. We're not going to rehearse and go over those same old details. We've got a table to illustrate the impact. The third thing that's not often considered is actually the company providing benefits to you. So let's have a look first of all in terms of the salary. Summary of the general situation here, you've got three things to consider. Your status as a taxpayer, so if your income is below 50 grand, salary, overall tax rate for company and yourself personally is 40%. You as an individual, in terms of taking it out as dividends, the overall tax rate is 25. Really good advantage for dividends in that situation. If you happen to be what's called a higher rate taxpayer, 50 grand plus, then paying yourself salary is an overall tax rate for you and the company at 49. Paying yourself dividends is about 45%. So the gap really narrows, but dividends are still, more preferred. If you happen to be in the blimey rate, that's if you're 150 grand a year plus, great target to get to, then the salary route is 53% overall tax burden for you and the company. Dividend rate is 50% overall. So gap's really narrow, but it's still the edge is given to dividends. Now, route number 3 is benefits. So there are some benefits the company can pay for, which is all tax-free, tax deductible, so things like providing a mobile phone, health screening, eye tests and the like. In other situations though, it's still worthwhile to consider the company actually paying for things you would pay for personally. And the way you've got to look at it is, what do you need to take home to pay for those benefits? So what I've done here, I've summarised 3 scenarios. If you're a basic rate payer, look at those wonderful savings. The company provides the benefit, you still pay tax, but you're still better off. And it's all about money in this situation. You're a high rate payer, the savings become much bigger. Again, that's taking all those wonderful factors into account. And lastly, if you're in the blimey rate, then the savings become much more bigger. So, always worth considering. So, hope you found this useful.
Okay guys, so come on, get on Facebook, like us on LinkedIn. We know you're loving it, guys. Keep liking us and head over to the website as well. Have a look at the blog in more detail because there's lots of interesting stuff on there, as most of you will know if you've been on there.
So, this is all from us, from the numbers guys, hoping to turn your tax frowns
into smiles. Ciao.
Ciao.